Hello, welcome to the latest PIMCO trade floor update. I'm joined by Aditya Thacker for this month's update. Aditya is one of the portfolio managers in our Sydney office. Welcome, Aditya. Aditya, there is a surge of COVID-19 cases in the US, Russia, and many other emerging markets. There are also growing geopolitical tensions, for example, China and the US and China and India. Have these factors changed our views about a slow U-shaped global recovery and inflation expectations?
Well, coming out of our most recent cyclical forum, we retain the view that the recovery will be slow, bumpy and U-shaped. The recent spikes in COVID cases in the US and even here in Victoria, where Melbourne has been placed back into lockdown, speak to this theme. The key question for us and investors is whether asset classes are reflecting this reality. We think that the very vigorous bounce back in equities suggests that they're pricing in a much more optimistic V-shaped recovery, whereas the bond market is pricing in quite soggy growth and inflation and central banks on hold for a very long time. So putting this together, we see that the risk to equities and risk assets more broadly is skewed to the downside, should our view of a U-shaped recovery pan out. And with that in mind, we think that core bonds should be retained as a very valuable source of risk diversification and income, especially at a time when cash rates are near zero.
Yields on corporate bonds and other sectors have fallen, both in absolute terms and relative to government bond yields since March. This has the implication that valuations have increased on those bonds since then. Aditya, what opportunities do we still see in credit markets, and where are we allocating across the investment grade and high yield space? And also, what sectors are we avoiding?
So in Australia, unlike the US and Europe, corporate bonds and other non-government bonds haven't been purchased by the Reserve Bank as part of its quantitative easing program. But that has meant that Aussie corporates have actually raised equity and cut dividends, much more so than in response to the GFC. They also have tapped short to medium-term financing from the major banks, who in turn have very cheap funding from the RBA. So that's improved liquidity and creditworthiness of Australian corporates in response to the COVID crisis. Overall, valuations for Australian credit have also improved, both from an absolute sense and also on a relative value basis when compared to equivalent European and US investment grade bonds. This, along with the great need for income at a time when cash rates, deposit rates, TD rates are nearing zero and well below inflation, the demand for credit and its higher yield remains very strong. So talking more specifically, we generally favour sectors which have low impact from the COVID crisis, things which are more regulated or monopolistic in nature and have key kind of defensive infrastructure-like assets. So things like utilities, pipelines, telecommunications, energy, toll roads, and some tech-related names which benefit from the increased demand resulting from work from home. Areas that we continue to avoid, however, are those most impacted by COVID. So that includes things like retailers, REITs, airlines, regional airports, and other names more exposed to tourism.
Quite a bit of the valuation impact in recent months was caused by illiquid markets, meaning there were forced distressed sellers, which greatly outnumbered willing buyers. Aditya, how have we been capitalising on the liquidity imbalance to capture returns for investors?
Through the market sell-off, or the risk-off period, illiquidity risk came to the fore, and those forced or distressed sellers had to accept lower prices, and so we took advantage of this. Firstly, in primary markets, where new debt issues had to come with a significant price discount, we were able to pick up bonds which were sometimes 25 to 50 basis points cheaper to the equivalent issues in the secondary market. Secondly, within the secondary market, we were also able to deploy capital in areas like residential mortgages, where forced sellers and distressed sellers had to accept much lower prices. We could deploy capital in buying seasoned, short maturity, very high quality mortgage pools at very attractive pricing, again, 20 to 50 basis points cheaper than where they would price normally in the secondary market.
And finally, Aussie banks have rallied of late. How are we seeing Aussie bank bonds relative to global peers across the capital structure, meaning relative valuations from the senior secured bond end to hybrids?
Whilst the creditworthiness of Australian banks remains strong, with ample support from the RBA via liquidity provision and very cheap term funding, I would make the following points. Firstly, we expect non-performing loans, or NPLs, to rise as government fiscal support programs are reduced and the true impact of COVID is realised. Secondly, Aussie major bank capital levels lag offshore major banks in Europe and the US, where regulatory response to enforce higher capital ratios began at a much earlier stage. And thirdly, the spreads for senior bonds are quite tight relative to offshore major banks, meaning that Aussie bank senior bonds are relatively more expensive than global peers. Therefore, we have a preference to be underweight the senior part of the curve in Aussie banks. We see some value in the subordinated layer or the tier 2 segment, but further down in the more equity-like segment like additional tier 1 or AT1, we again have a preference for stronger global major banks in Europe and the US.